Atocha Global Analytics. Please like and subscribe.
Greetings, salutations, and howdy to you all. Welcome back to the channel. I'm AT with Atocha Global Analytics. Again, Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. So today I want to share with you something that we use daily here at Atocha Global Analytics and share it so as to really empower all of you to expand your analytical process. Here's a shocking statement that should make perfect sense to anybody with any analytical ability. Many of the economic-centric statistics here in the U.S., stats that are associated with GDP, employment, unemployment, etc., these stats have become increasingly unreliable. And today I'm sharing with you some of the better sources of the data we need in order to make good decisions and what those are telling us about our economic future. So just to put the issue with data sources into context, many of the stats released in the U.S. are developed using models, which means they infer or assume internal components upon which they construct the models. And those inferences undermine the foundation of what becomes their published conclusions. So one of the reasons so many stats are later revised here in the U.S., to reflect what the actual data is supposed to support, is because the models have made incorrect inferences. And many models also aren't contemporized to reflect a truly current reality. In some cases, even the data that comes out later is also shown to be skewed or unreliable when reviewed months or years later. So now, I imagine somebody hearing this immediately assumes I'm inferring a political bias or some conspiracy that is causing this. And let's make it clear. I am not. I repeat, I am not stating that. What I'm stating is that these models have built-in assumptions that though they may shift over time or evolve over time, they cannot keep up with the economic realities that we face, especially given the change we've had in recent years. And, they have structural flaws that inherently undermine their reliability. So, one quick example that clearly demonstrated this within the last year. But before I cover that example, though, please like, subscribe, ring the notification bell, and help us build our channel. So I appreciate that. So here's the example. The Federal Reserve, which many assume is a quasi-department of the federal government, but by the way, it's technically a private and independent bank, though that doesn't necessarily completely pass the smell test when you look at it. But in reviewing their own independent data regarding the jobs market back in December, the Fed refuted the official Q2 2022 unemployment stats stated by the Bureau of Labor and Statistics. A report from the Philadelphia Federal Reserve Bank claimed that the official stats overstated the number of jobs created by well over 1 million jobs. The official number in Q2 of last year was 1.12 million jobs created. But the Fed found that it was only about 10,500 in total. So a slight difference of almost the entire number was incorrect. So yeah, it's a slight difference, you think, but I've included, by the way, a link in the comments that will take you to the broadcast video that covered the release of the Fed's report at the time, CNBC, and other stories covering this discrepancy between the BLS and the Fed numbers. They scapegoated the life-death model used in generating the employment stats, meaning the creation or closing of small businesses, life and death of small businesses, which these aren't very easily tracked, obviously, but they're tougher to track than, say, as opposed to more conventional employment anyway. But regardless of why the two numbers were so different, and they were clearly vastly different, this highlights that not only the quality of your data really matters, but also whether it can be objectively verified. In that case, they weren't using good verification safeguards, and they typically don't. And the Fed backstopping them found something vastly different. So now I'm not stating we should disregard everything that the government puts out or even anything that is available from these U.S. sources, but you need to have that independent, objective support for whatever data you rely on whenever you can. Some of the best sources we found are outside of conventional academia. They're outside of conventional government sources, and they're often sources located overseas. The U.S. media, even the business media, is not uniformly reputable globally. And many of the stats released by the U.S. government have been increasingly unreliable, especially in recent years. as such, we at Atocha Global Analytics and many of our contemporaries, we always try and seek out sources that are not beholden to the internal machinery and the markets of the U.S. Whether the lack of domestic independence is from some sort of coercion or simply a lack of really independent thought, I can't really say. But betting from an objective perspective can make all the difference in the success or failure of a financial decision. So I seek those objective perspectives whenever I can, and I recommend my clients to do as well. Of course. If some potential event, and I want to make this caveat, if some potential event out there is of concern to U.S. officials, say something might inadvertently cause, a concern to manifest into reality. I'll give you an example. Like if policymakers were concerned that the U.S. banking system was at risk, like they were, and many claimed that they were in March of this year, would it have been responsible for those policymakers to voice the concerns at that time? Well, no, it wouldn't have. However, at the time, they stated everything was fine, but they immediately created a brand new lending facility for banks to use and very quickly slowed their interest rate raises. So this is just an observation. Typically anything related to government does not move very quickly, much less immediately, unless there is some sense of urgency. So the actions they took speak to their level of concern, even if their words spoke to calm and lack of concern. So, and in my opinion, the public statements they made calmed fears and were therefore correct. And the actions at the time they took to create the lending facility and such, those were also correct. Now, what policies were applied that led up to March 2023? Many of those policies I don't agree with, and I believe are complicit in causing the problem to begin with, but I'll save that for another video. So after explaining the challenges with the data here are some of the better sources and what they're telling us about our economic future. But before I cover those sources, their benefits and the like, please like, subscribe, ring the notification bell, and help us build our channel. Again, I appreciate that. So what are some of the better sources? How's that? We can't really share too much because if we do, we lose our value as a firm. However, we find that there are a number of internationally recognized non-governmental organizations that provide consistently reliable data on the U.S. and they will publish the unvarnished truth on the U.S. economy, even if some of the stats here seem askew. Similarly, they will, they or others will publish good data about other national economies, like say China or countries in the EU or even the EU itself, et cetera. So one of our favorite sources is called the Conference Board. And they're a great example of what I described. And I'm reading here directly from their website. It says here, it was founded in 1916. The Conference Board is the member-driven think tank that delivers trusted insights for what's ahead. Our mission is simple: to help leaders navigate the biggest issues impacting their business and better serve society. And scrolling down a little bit here, hold on, their info page, it says, because we are independent, nonpartisan, and nonprofit, our work is trusted. So that encapsulates what I described: nonpartisan, non-governmental sources, and without a vested interest or a bias that can undermine their conclusions. Some other sources we include, the International Monetary Fund's a good one, World Economic Forum, and other entities such as that. But all these data sources need to be vetted to confirm that they aren't compromised in some way. And, that is an ongoing process. Now, there are always some differences in the estimates between these different sources, but usually they generally align. But sometimes the differences in their conclusions are massive. And the area of economic growth happens to be one of those areas that the gap is a bit more profound than some others. These trends have been especially pronounced in the last several years. So, what are these sources really saying right now? Well, to put a fine point on it, what these alternate sources are saying is growth is slowing and about to go in reverse. So they're forecasting a recession. Also, the banking sector, which was under stress in the spring, has not miraculously recovered, and those issues are also forecast to become more challenging in the foreseeable future. Many are predicting that right now is just a calm before the storm, especially with European banks. However, let's cover the banks in a bit. First, let's cover GDP forecasts. Okay, so the U.S. forecasts domestic GDP to provide guidance to our business climate, et cetera, and various U.S. governmental sources also forecast the expected GDP for these other economies around the world, not just our own. Similarly, other entities forecast the U.S. GDP and global GDP in the same way that we do for them. So, so you get these different numbers. You also have different perspectives and different rationale to generate these different forecasts, published by domestic and international sources. And the collective brain trust is currently at odds. The forecasts are divergent. So we have the official U.S. forecast. That they're not aligning with these outside independent forecasts. And the forecasts from an independent perspective are showing this recession. Why? Well, here's the first official forecast. Directly from today's White House website, we get this dated statement. Real GDP is projected to increase at 3.8% in 2022 and 2.5% in 2023. Real GDP growth is then expected to average 2.0% between 2024 and 2028 and 2.3% during 2029 through 2032. So that's a pretty tepid forecast going forward when the long-term real GDP is about 3.13% officially, and we've averaged about 2.5% in much of the previous decade after the Great Recession did all the damage, et cetera. But, let's be kind and let's just call that a conservative estimate. So let's not judge that growth forecast from that perspective that they were incorrect. Instead, let's review the alternate forecast to see what is being said about things going forward. Well, the U.S., by the way, did not meet its 2022 target of 3.8%. And it's falling far short of those forecasts going forward. So here's the real numbers. The U.S. only made it to about 2.1% GDP in 2022 and is forecast to generate 1.3% and 0.1% respectively in the next 2 years. So, wow, huge difference here. But you're likely thinking, well, who says so? Well, the entity referenced is one of the most respected non-governmental economic forecast sources that I'd already referenced earlier, the Conference Board. They are forecasting a recession to begin in the U.S. sometime this quarter, third quarter of 2023, and continue into the first quarter of 2024. So that is a short recession they forecast, but it is clearly quite different from the one the White House website happens to show. In addition, the Conference Board is also referencing what's going on elsewhere. China is seriously underperforming its long-term norm, and many economies in the EU are forecast to be in recession in the near future, if not already. What happens if China underperforms, for example? Well, it's about 18% of the globe's GDP, and then could affect our economy. During the Great Recession, China held up pretty well, so they didn't pull the world down. But things have changed since then. How about the EU? Well, the EU is 16% of the globe's GDP, and it could affect us too if they go down. However, the U.S. they've long had this perspective that we are the biggest and strongest economy on the planet, so we can weather their problems without them infecting us. Well, we can, and we have when we were more dominant for sure, but what if both China and the EU are struggling at the same time like they are right now? In the past, we were big enough that we didn't get buffeted by international economic storms as much, but we are now 25% of global GDP, and they are 34% combined. So in total, that doesn't sound like a great scenario for us to continue growing. But a forecast is not the economic gospel truth. We really need some more data. So what else can we rely on? Well, before I disclose that to you, please like, subscribe, ring that notification bell, and continue to help us build our channel. So thanks again, man. One thing we can rely on is an alternate method of calculating economic growth and input, like, say, gross domestic income, which is also abbreviated GDI. Everybody's used to using the archaic measure for economic output, GDP, but GDI is actually more insightful to real economic activity. It isn't convoluted in the same ways that GDP can be. GDP has inputs that inherently don't tell the whole story. Government spending is in GDP, and that's not tied to production. Government spending isn't directly tied to anything except borrowing. Also, since GDP includes consumption, which includes different types of spending, inflation driving prices up also increases the nominal amount of consumption included in GDP. So these sorts of distortions aren't included in GDI. So let's look at the GDI numbers. In 2020, we had that crash in GDI followed by a quick rebound to recoup what was lost. This is clearly tied to the pandemic-related issues and subsequent reopening of the economy in 2021. That shows some modest growth afterward. Now, we had 2 negative quarters of GDP in the first half of 2022, but we were told that was not a recession. As you see here, starting in 2022, GDI began a decline until we got to a slight bump in Q1 of this year, 2023. What that means is that the economy is and has been effectively much slower than GDP has been communicating in that stat. Also, the trend has been downward since early 2022 generally, and the inputs in GDP that aren't directly tied to the quality of life for a large percentage of the U.S. residents, those inputs aren't really distorting the numbers when you use GDI. So this becomes a better measure. However, there's one problem with using GDI, as I've disclosed, to measure this. That's inflation. Just like GDP, you have both nominal and real results that are adjusted for inflation. So this is nominal GDI, but the real GDI shows what it is after inflation. So here's that. Real GDI, which, by the way, it's not calculated in a straightforward way like simply taking the GDI minus CPI, because that'd be too easy. But GDI shows we've been negative 3 out of the last 4 quarters. So even as inflation has come down, GDI has not improved. The average over the last 4 quarters is a negative 3.1 GDI. If GDI, which is supposed to be an alternate but valid measure of economic activity reported by the Federal Reserve, tells a slightly different story than GDP. So what does this negative GDI really mean? Let's put it in context. Well, if GDI was what they effectively used to measure a recession, we'd be in a nasty one that started in 2022 and it's continued into 2023. We won't have the Q2, second quarter 2023 data for a couple months, so we don't know about that yet. However, minus 3.1% GDI is typical of past recessions. The average decline in GDP during recessions is 2%, but that is, those numbers are softened by government spending and private investments. Whereas if you look simply at real GDI, so it's apples to apples, you ignore the Great Recession, the pandemic, because those are outliers, but that 3.1 negative GDI is equaled in the dot-com post 9/11 recession, and it doesn't get equaled again until the double dip recessions in the early 80s. So, GDI is as bad so far as any typical recession we've had since World War II, but we haven't been in a declared recession yet. We also have been in negative for more quarters so far in 2022 and 2023 than we were during the 2001 recession. So we are clearly in a slowdown despite no declared recession, but the economic conditions are not quacking like the typical ducks we've seen in the past here, So, by the way, the Conference Board prediction I stated earlier, where they forecast entering a recession Q3 2023, that isn't nearly as prescient when you include this data in there. They're simply looking past the headlines and reading the tea leaves by looking at something like GDI and some other indicators. And here's some other data we have that are indicators that they'd use. And I'll tell you, but again, please like, subscribe, ring the notification bell to help us continue to build our channel. But we have a couple other things that act more like a canary in a coal mine that we want to highlight. The current reality is, it's still heavily shaped by the lockdowns and the aftermath of supply chain shortages, call it a hangover. We were short on things because of supply chain and other issues, couldn't get stuff to our local stores, but then businesses ordered a lot more inventory than they needed because they were left hanging so much because of the shortages. And they've been doing the destocking for about a year or more because they have too much inventory on hand. So, manufacturing, the manufacturing of all our stuff has slowed since the orders are way down. And freight has been quite slow domestically and globally since there's less stuff to move around. So, by the way, our Fort Coast Friday video feature that we do every Friday, this tracks these things, with verifiable metrics. And I just noted a freight recession last Friday in that video. So, but again, China is slow. Freight charts for them and the EU, they demonstrate this. U.S. traffic, import traffic, both imports and domestic traffic, way down. Rail traffic, even roadway freight, are all showing weakness right now. And then we get to this for overseas. Here's the headline: Flash PMI signals further cooling of developed world economic growth in July. So, two final things to address here. Banks will cover here in a moment, and that's very telling. But first, I noted this flash, meaning quick, undersized sample. The PMI is the Purchase Managers Index, or PMI. The results came in soft for the U.S. and the G4, and the G4 is Brazil, Germany, India, and Japan. These things were headed south before, but indications are it's quickly getting worse there and here. So it's time to buckle up, buttercups. I'm posting graphs from a source article so you can see visually, but let me summarize. By the way, the PMI, ISM PMI, was at 46.0 in June. So we are under that 50 baseline for the aggregate. So we are considered to be in contraction territory. Contraction is another word for recession. The U.S. actually crossed that threshold back in November 2022, and we've gradually declined since, as you can see in the graph. Here's a summary from the article I referenced. It says here, economic growth trends generally worsened at the start of the third quarter, according to the Flash PMI surveys. U.S. business activity growth slipped to a 5-month low, and the U.K. slowed to near stagnation, with the Eurozone also falling into a steeper decline. Growth in Japan, meanwhile, held stuck at June's 4-month low. In all cases, encouraging robust growth rates seen earlier in the year are showing signs of faltering as a persistent manufacturing malaise is accompanied by waning demand for services. The flash survey price gauges are meanwhile sending mixed signals, with cooler inflation signal in Europe, but with signs of stickiness in the U.S. around the 3% mark, which may have inspired the Fed to lower rates a little bit in order another quarter point. But anyway, and it continues here, there is a recent deterioration in order books and a sharp decline in business confidence across the G4 economies. Business activity across the 4 largest developed world economies slowed for the second straight month in July, down to its weakest since February. Manufacturing output in the G4 economies contracted for a third consecutive month, and for the 13th time in 14 months. So this is not a new thing. The service sector, meanwhile, continued to lose growth momentum, expanding across the G4 in July at its slowest rate since February. New orders growth slowed especially sharply. Europe saw the steepest deterioration in performance, though growth also slowed in the U.S. and remained subdued in Japan. The PMI nonetheless signaled a decline commensurate with GDP falling at only a modest 0.1% quarterly rate in July. However, the region saw a steepening loss of new orders and a steep decline in business optimism, boding ill for output growth in the months ahead. Growth remained more resilient in the U.S., though nonetheless weakened sharply to the slowest in 5 months. The latest flash composite PMI reading is indicative of U.S. GDP growing at a quarterly rate of just under 0.4% in July, down from around 0.5% in the second quarter. A largely becalmed manufacturing economy was accompanied by a downshifting of service sector growth to the weakest since February. So we need to watch all this and adjust what we do accordingly, especially when all this data is out there. But the Federal Reserve raising the Fed funds rate by another 25 basis or 0.25% is flying in the face of this kind of data because of their inflation concerns. Their agenda, both by their actions and by their comments, state that a recession is acceptable as long as they reach their objective, which is meeting their inflation target and staying there. So now let's cover the banking. Again, one last time, please take a moment to like, subscribe, and ring the notification bell to help us continue to build our channel. So banks here in the U.S. are still stressed, but the EU banks seem to be faring even worse. Stress tests in the U.S. or EU, as they've been created, they don't work in the current environment with too many variables, like higher inflation, higher interest rates, falling asset prices, falling loan activity now, higher lending standards, falling deposits, etc. So, this is a concern that I'll address really in a moment. But here's what the latest bank snapshot out of the EU showed us. And I'm quoting here. In its quarterly survey of 158 big banks, the European Central Bank said that demand for loans from businesses over the last 3 months fell at the fastest pace on record. The time series, by the way, began in 2003. And banks tightened their credit standards to consumers over the last 3 months. So as you can see on this graph, what they called a fall could be described as a collapse. It is literally lower now than the lowest point seen during the financial crisis in the 2008-2009 timeframe. If banks aren't lending, a lot of business activity doesn't happen. If business activity doesn't happen, the businesses can't maintain staffing levels. Layoffs undermine spending, and ultimately reinforce economic uncertainty. It's a painful, vicious cycle. So, these are all concerns, and we will be keeping an eye on these and reporting. Again, look out for our Forecast Friday, a video segment where we cover this every single week. So that was another substantial video, and we appreciate you joining us for this journey. Please take a moment to like, subscribe, and click the notification bell, and we'll see you in the next video.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.